Activist investor Jonathan Litt is bearish in office space, warning back in the pandemic's early days a hurricane was coming. He's the chief investment officer at Land and Buildings. Jonathan, welcome back. You came on the show actually at the beginning of the pandemic, and that's when you said you were shorting. So where are we right now in that hurricane phase? One broker described it as gale force winds. So it's still raging. We were overly optimistic when we wrote that white paper in May of 20. We thought 20% less people in the office, 40% declines in value. We have over 40% less people in the office, and we're probably going to have 50 or 60% declines in the value of the office buildings.
So let me ask you, of that, what were your assumptions about interest rate at the time? Because that cap rate issue with interest rates here is, that's an enormous
Right. I mean, the two things we didn't anticipate was interest rates being where they are and inflation being where it is.
Right. So those two things bigger than the other two.
Much bigger. That inflation, if you have no rent growth and your vacancy is going up and you have giant operating expenses to run an office building, you're going backwards fast. And that's one of the big surprises that we did not anticipate.
We've seen a lot of washout for a lot of the stocks. I mean, SL Green is trading back to like IPO levels, back to 1997. So I wanted you to walk through, if you could, a short that you have on currently, and just to sort of give us the characteristics of what you're looking for in a short in the space currently. JBG Smith is one of them.
Yes. So we've been short the space since May of 20. There's not a lot of market cap left in a lot of the companies, and I know a lot of the management teams. I feel bad for them. It's not their choice. It's what's happening. JBG operates in Washington, D.C. Washington, D.C. is one of the toughest markets in the country today. We have, and they have a substantial office portfolio. And I'm going to do the rule of 40 for them. 40% of their leases come due in the next 2 or 3 years. 40% of their debt comes due in the next 2 or 3 years. 40% of their rent comes from Amazon and the government. And they have over 40% less people in their buildings. So they have a real challenge. We know Amazon's moving out. That's 15% of their rent roll that they're going to lose from their office portfolio. It's going to be really hard. This isn't a work from home story anymore. This is a financing story. It's kind of like the mall business went from the mall problem to the financing problem. Now it's a financing problem. And as these debts come due, there's really nowhere to go because lenders aren't lending to the space.
Historic trade, Jonathan. Congratulations. So connect the dots. What does it mean for local economies? Because so many of these businesses are basically predicated on people in office buildings, going to restaurants, shopping in the area. It's got to be catastrophic for a lot of these local businesses.
The mayor of Washington, D.C. came out and was complaining that they're not forcing government workers back into the office. And he said, we're going to have to dramatically cut the budget if we don't get people back in the offices to support all the local businesses. It's going to be a real problem. Now, the flip side is it's happening in the suburbs. So where the people are working from home, they're going for coffee, they're having lunches, they're going to the stores, the supermarkets are doing better, but the cities are going to struggle.
How will you know when it's time to go long?
That's a good question. We monitor it. One of the things we monitor is cell phone data to see if people are going back in the buildings. We could put a box around every office building a company owns, and we're just waiting to see some uptick, and we're just not seeing it. But that's really going to be the signal on the other side.
And from your vantage point, how big of an issue is commercial real estate?
It's a good question. I get a lot of calls on this, and I'm just going to go through the math quickly. $5 trillion of commercial real estate debt. So people think, therefore, it's going to take down the regional banking system. The problem's office, and that's $1 trillion. Regional banks have about $600 billion. So if you take a third hit to that 600, it's a $200 billion problem for the banks. I think that's manageable. The banks need to lend. They're going to lend to apartments. Apartments are fine, warehouse, and other sectors. They're not going to lend to office.